Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters.
We are back, episode 175 of Facts versus Feelings. Ryan and Sonu here. Sonu, we have the intro music and thing before we come on. We probably need to update it though, because somebody has a new title around here, right?
Oh yeah, I forgot. Yeah. Chief Macro Strategist, and so there's no comma anymore about that.
And I wasn't trying to confuse you with your title. You almost said it like you weren't sure what your new title is, but as long-time listeners know.
Took me a moment.
Yeah, I know. Long-time listeners know we've had fun with that comma VP. We joke we've been told you have to add it, so we've taken that to the extreme, but we also thought it was a little silly. So you are now the chief. What is it? Chief Macro Strategist?
Yeah.
Okay.
Luckily, one way to think of it is also pretend economist. So for what that's worth, maybe it's good to be a pretend economist as opposed to the real thing.
Well, I mean, why did God create economists to make the weathermen look good? That's a joke I've used in every presentation for about 20 years. It always gets a chuckle.
Someday you're going to meet a real economist who's going to have words with you on that.
Well, they're going to have a bow tie on. I'm just going to laugh at them. I know that much. A real economist has to have a bow tie on. Anyway, so you're out in California. Is the sun just came? Lean back on a YouTube channel. Lean back. Look at this. There's the sun. Look at that. Yeah. What time is it out there? Pretty early, right?
It is 7 o'clock in the morning, but it's 9 o'clock Chicago time. So I'm in Palm Springs. I've never been here. So, if anyone has any recommendations, you want to put it online, by all means. I have one more day. So, maybe check the scene out after my meetings.
Yeah, exciting. That's good. I've been traveling a lot the last month. I've been on the road a lot. I'm home this week and next week, so that'll be nice. And you and I get to go to Miami in a couple weeks for Future Proof.
Speaking of sunshine and sand.
Yeah, exactly. We're doing a live Facts versus Feelings on Tuesday morning at Future Proof. I believe it's still open, so if you want to check it out, it should be a lot of fun. I mean, there's, I don't even know the number, thousands of people that are going to be there. At least two. Yeah. Two. Sonu and I are going to be there. So that's enough small talk. I've got more coming, but let's get into it. We're going to call this week A Tale of Two Markets. There's a lot of ways to take this. I'll set it up here. I can give bullish, reason to be bullish and bearish at any time. We get paid to worry, so there's always things that I wonder about. You've got regional banks potentially breaking out to a 10-year high, yet large cap banks, the big super money centers, have been struggling. You have different areas like small caps doing well, large caps not. For the year, Mag 7, all those stocks are down on the year. I'm sorry, they're all underperforming the S&P 500. I believe they're all negative. Mag 7 is down 7% on the year, yet equal weight S&P 500, so think kind of the 493 in a way, is up like 3% on the year. There's a lot more, but I mean, it's a wild market. One more, then I'll go to you. Just recently, I think last Thursday or Wednesday or Thursday last week, more than 20% of the stocks in the S&P 500 made a new 52-week high on one particular day. So it's more than 100. But 6% made a 52-week low. I mean, that is really rare. Like there's a dispersion going on out there, and maybe one more on the YouTube channel. We can put this up right now. The widest dispersion between S&P 500 winners and losers over the past 30 days, like we've seen in a very long time, which again is not surprising. We've had some huge winners out there, and we've had some huge losers out there over the past 30 days. Sonu, where do you want to take this conversation? But it's a tale of two markets.
Let's just look at sectors.
Okay.
Right? If you just, I think the one bearish case you could make, I imagine this is something that bothers you, and is staples. Staples are performance. Consumer staples are up 15% year to date. The S&P 500 is flat. Just right now, flat. The consumer discretionary stocks down about 3%. Financials down close to 6%. Technology, we'll talk about technology because I think there's a tale of two technologies or three technologies within tech itself. We'll come to that. Tech is down 3%. So staples, you look at it like, wait a minute, 15%. But then, Ryan, I look at, so that maybe that's the bearish case, right?
Yeah.
Then I look at industrials. Up 12% year to date. I look at materials, up 18% year to date. I look at energy, 22% year to date. And that's just on the US side. Small caps are up 7%. year to date. You look at the value side of small caps on your style
Mm-hmm.
box. You have growth and value and core. So core small caps, Russell 2000 is down about is up about 7%. Small value, Ryan, Russell 2000 value is up over 10%. This is not
Wow.
a risk off market if
No,
you look at
no.
the underlying stuff, right?
It's really not. I mean, just last week we hit new highs on the advanced decline line for the
There you go.
NYSE for small caps at 52-week high, mid cap advanced decline line hit an all time high. Yet, like you said, I mean, we see some defensive areas leading, and our buddy Scott Brown, who's been on before, and I've watched Scott for a long time. I'll never forget in the fourth quarter of 2021, everybody's bullish. Everybody made a bunch of money, and Scott's out there very quietly, no one was paying attention to him, including the place we worked at the time. I know for a fact because they all ignored him. He's out there saying, hey, look at this. Something's wrong here. We're getting leadership from staples and the defensive stuff. And sure enough, 2022 happened. Now, we're not saying it's another 2022 on the horizon. At the same time, I don't think it's that shocking. Drew, we can share on the YouTube channel again, just the chart I sent on February. February is not that great, but the banana peel part of February is the second half of February. Now, no, we don't blindly invest just on the calendar. But the Dow is up 9 months in a row. The S&P 500 is up 8 of 9 on a total return basis, up 9 months in a row on the S&P 500. It is what it is. We've had a heck of a run. This kind of consolidation, frustration. We talked the past couple of weeks about tech.
Rotation, right?
The rotation. If you came into this year heavy Mag 7, and a lot of people did, this market feels a heck of a lot different than if you have an equal weight portfolio, or heaven forbid, one that's skewed. Like we've been saying, if you drop it, hit your foot and it hurts, your materials, your energy. Not saying go all in on those, but at least having a little bit larger, even gold. What's gold up for the year? Double digits still, right? I think something like that. I mean, which is wild. Which is wild because it had that crash a few Fridays ago. I truly can give a bullish or bearish take. My take again is we're just due, Sonu, maybe for a little choppiness, maybe for a little frustration. And that is clearly what we've been seeing, but that's not the end of the world. Dow's up 9 months in a row, everybody. They can't go up forever, and we are in February, so maybe we just get a down month, get it out of the way, rip the Band-Aid off, and then we go forward. What else you want to talk about on this subject, Sonu?
And that's only the U.S. story. If you invested in the, just global stocks, just take roughly MSCI ACWI index, all cap world index.
Okay.
The S&P 500, like I said, would have been flat. But if you were like sort of 65% US stocks, 35% international stocks, you'd be up over 2% year to date. Not too bad not too shabby for 6 weeks into the year, right? And that's because we were talking about small cap value, right? Russell 2000 value being up over, I'm looking at my data here. Yeah, Russell 2000 value is up over 10%.
And I'm going to jump in I can't stress how much people hated that group 2 months ago. Like literally, everybody hated small cap value because it had done nothing forever. And here we are. Go ahead, Sonu.
And you know what's in that? 25% financials. 13% industrials. So we're looking at close to 40% in financials and industrials. That is not a risk off market. Then you think, you know what else has a lot of industrials and financials, Ryan? Developed markets. You look at the MSCI EFA index, it's up about 8% in US dollar terms. And that index has about 23% industrials, 22% financials. We're talking about 45% in, sectors that are traditionally risk on. Then you look at MSCI EM, right? Emerging markets. That's up 11%. We'll talk about South Korea. I think this feeds into an inflation story as well, especially when you look at energy's up, materials are up, industrials are up. Emerging markets, that's up on the back of South Korea, which is up 35% year to date. 35%.
Year to date.
We'll talk about that. We'll talk about the whole memory issues and memory chip shortages and DRAMs and things like that. But market-wise, none of the. It's hard for me to make a very bearish case, except for that one data point of staples doing really well.
Yeah, then you look at like consumer discretionary. Parts of the consumer discretionary have been very weak. Then you look at housing stocks. Housing stocks have been on fire. I mean, it truly is a tale of two markets. We can slice and dice this, but I think it's just really, really interesting. I don't have too much more to say on this. I know there's more we want to get into, Sonu. I mean, the one thing again about we talked about last week's podcast, just how this AI fear, right? The fear hit the SaaS stocks, the software stocks. Well, last week, kind of our industry, broker dealers. Probably won't mention any specifically. You can look it up, but a lot of the large broker dealers, we're down like 10%. I think it was on Tuesday or Wednesday of last week. Altruist came out with a tax strategy using AI, and in mere seconds you can have all these different tax strategies out there, and that led to a sell first, ask questions later mentality. But the one that really got me, and I guess I must have missed it when it happened, on Thursday, the trucking sector was down almost 7%. Okay, what is it? C.H. Robinson, which was like one of the largest, they were down like 25% at one point during the day. They came off the lows. There was an $8 million market cap company that used to make karaoke machines, okay? And now they came out with a logistics AI bot. And I, again, go read about it. I just know at high level.
One thing with this stuff is nobody's seen the demos or anything. Like, what exactly these things do?
Well, that's what I'm saying. Nobody knows. I mean, I'm sure they're wonderful karaoke machines. I'm not saying, but that is an $8 million market cap company just took tens and hundreds of $50 million away from the trucking and logistics area just on Thursday. And again, on Wednesday or Tuesday, we had a hit from the broker dealers. We talked a lot about SaaS. My goodness, we don't need to talk too much more about that. But it is just like every day you pop your head up like a little mole. You pop your head up, and it's like, oh, what is AI going to disrupt today? I don't know where you want to take this conversation, Sonu, but I think it's one that we keep hearing about, and it doesn't seem to be going away.
I mean, one side of it is, and then you had things like LegalZoom, I think, right? Which tanked as well. That was another one. So it's coming for financial services. It's coming, AI is coming for legal, work. It's coming for software, and
Luna's not coming for. Here's my Detrick whiskey right there. This is like Coca-Cola, Staples. I mean, things like that. AI's not coming for that. I mean, Josh Brown, I'm a big fan of Josh out of Ritholtz. He's got that theory that, now it's like, if it's connected to AI, we're selling it. But if AI can't touch it, that's where we're buying. I think that's partially why Staples have had such a big bid. Go ahead, Sonu.
And Walmart too. Speaking of, somebody who sells stuff, right? That's. I mean, this gets to investing is not an easy business. If you think about, like, even 5 years ago, 10 years ago, who's going to be the winner of e-commerce and things like that? What name pops to mind? Amazon. Not a recommendation. But you look at Amazon versus Walmart. Walmart's, stock has crushed Amazon stock recently.
Yes.
Right, and that's an incredible story.
I believe Amazon's down 8 or 9 days in a row the time we're doing this, like one of the longest losing streaks ever in the history of that company.
No, and the other side of this is we were talking about South Korea. We'll come there.
Okay.
All this AI talk also means, what do you need? You need more AI, so which means demand is only going up. You need more demand for chips. You need more demand for all this construction of data centers and things like that. So that story is sort of still intact, right? Like I said before, tech. The Spiders Technology Index is down about 3% year to date. Software, Ryan, is down 19% year to date.
Wow.
But then you look at, there are three big categories in tech: software, semis, and telecom. Semis are up 13% year to date. Telecom, Ryan, is up 15% year to date.
AI is not going to take your cell phone away from Verizon, apparently.
And then you look, and this has been, the story's actually been happening for about 3.5 months now. Since the end of October, tech is down about 8%.
Okay,
right. Software is down about 23%, Ryan. But then you look at telecom, it's up about 15%.
Wow.
Semis are positive as well, 2.5%. The overall market, S&P 500 is flat over the last 3.5 months, right?
Yeah.
So, there's like a tale of two markets.
You say 2 or 3 markets. Just a little pat on the back of our team. We manage money. We manage billions of dollars, and we actually added some telecom a while ago in one of our more technical based trades. And again, it's more of a defensive name. I think I would say telecom's more defensive, but I mean, hey, we'll take it. And that's that one's clearly worked out. It's just amazing, some numbers you just threw out there. I don't know what else I want to add there.
Yeah, maybe it's just stuff.
I do. Let me jump. Sorry, XLK, not recommendation, but that's the large tech. You said down 3% for the year. Short interest on that the last 2 weeks, really last month, specifically last 2, have soared. It's like the highest it's been in over a decade. And again, what's going on? Well, everybody and their mother turns on TV and sees how these large, specifically software, big names, Microsoft, big names, all those names have been crushed. No doubt about it. But then everyone's piling in on the shorts. I mean, that inner contrarian in me says, I don't know if it's going to be that simple. Right? I think we're closer. I'm hopefully not saying it's not too obvious because we are pretty optimistic still. Closer to a low than not in software, down 23%. You know, I mean, maybe a little more pain, but I don't think we're going to have too much more. And then I see all the shorts piling in there. And maybe it's hedging, maybe there's something to do with options. I mean, there's a lot of ways that can go, but still, that jump in short interest on the technology ETF Sonu has caught my attention, and it does make me think, you know, that there's a lot of unwind to any good news. And remember, last comment back to you. You mentioned this last week, but I do want to point it out again. History doesn't repeat itself; it often rhymes. Last February, we all freaked out over DeepSeek. Now, clearly, we're freaking out over AI. I think we're going to look back in 6 months, 9 months, and realize, wow, that was a great opportunity to buy companies that are still growing, that are still making a lot of money. Not saying they're all going to. There's issues. I mean, you know, these companies are in trouble because of AI, but not all of them. You know, they're throwing a baby out with the bathwater. There's a lot of companies, a lot of strong moats, and it's probably going to look back and say, wow, maybe that wasn't a time to panic. It was a time to, you know, at least be strategic about your thinking, just like last year was around that. What do you want to say there?
And the other side of this is, you know, going back to the international story, is AI just coming for the US? I mean, shouldn't it be a global story? Taking down, you know, global companies, and like, is it going to only take, like, I feel like, wait, this seems a very US centric, you know, worry and story right now. At least if I look at broad stock markets, right, across the globe. Like, Ryan, Brazil is up 19% year to date.
Wow.
Mexico is up 17%. Taiwan is obviously a TSMC story, chips and things like that, but it gets that story within tech as well, right? It's up 18%. Taiwan, Japan's up 15%. Australia's up 10. UK is up 7. Switzerland, maybe it's a gold story. It's up 6%. The one country that's not doing, even Canada, our brothers up north, our sisters up north, up 4% year to date. Right. And all of this was like, oh, the US is the most dynamic, you know, economy. Europe is sclerotic. Well, Europe's stock market is doing better than ours now.
Way better.
Right? Yeah. The one country that's not doing well, by the way, worse than the US, India, down about 3% year to date. Right, which is interesting. Now, what India did well, Ryan, which I'm kind of pleased about. We did beat Pakistan in the World Cup cricket.
That's all that matters. That's all that matters, right? There you go. You can take it. Yeah, you can take it. Well, good job there. I mean, I was just saying, you. One thing I was proud. Oh, go ahead. Do
you know 450 million people watched that?
No, I didn't.
450 million people.
So what time was it like here in the U.S. when you watched? I assume you watched it. What time?
Yeah, it was early morning. It says, you know, so by the time I caught it, it was, you know, maybe about a quarter of the way through, and that was about 7 o'clock in the morning.
Now we talk. I mean, yeah, I'll be honest. I think I know the answer, but I want you to dive in. I mean, you know, we live in the U.S. and I mean, Pakistan and India, you guys really don't like each other, like legit, like
legit.
You're not sending any holiday cards, right? It's legit, like. Hate each other for the most part. I mean,
this match was not supposed to happen, right? With that, you know, you can Google this and stuff like that. So India doesn't allow Indian players to go to Pakistan and play cricket. It doesn't allow Pakistani players to come to India and play either. And the World Cup is being hosted in India and Sri Lanka. Thankfully, Sri Lanka is there as co-host. So last minute, finally, the Pakistani government said, okay, the match can go ahead. And, you know, what's strange is, obviously, this is supposed to be a lucky draw, right? All these teams are initially, for the first round, they're drawn into different groups. Somehow, India and Pakistan always end up in the same group. Why? Because, you know, it's TV gold, right?
Yeah.
Everyone knows that. Somehow always end up in the same group. And this time, the Pakistani government originally said, oh, we're not going to let you play. But I think that was obviously, this is where maybe the money in TV counts. Finally, they were like, okay, we'll let you play, but the game has to take place in Sri Lanka.
Right.
So that's where they played.
What was the score? Do you remember?
Oh, India, you know, for all practical purposes, thrashed.
There you go. That's funny.
Sorry for any of our Pakistani listeners. I will admit, like my wife's family is originally, I mean, she's from Columbus, Ohio, obviously, but her family originally is from Pakistan. So
right.
There's not to, so I don't want to completely.
Wait a minute. We're going down a new path. I didn't think we'd go. So your father-in-law that you watched the Buckeyes with, he's a Pakistan.
Originally from Pakistan.
So he's rooting for Pakistan.
No, he's actually rooting for India. So he's
okay. I wasn't sure. Okay.
He had to,
Okay.
with long story short, he had to leave Pakistan. And,
Okay,
wasn't pretty
so
up
that's
there.
family Thanksgiving. A lot more interesting in your family when you show up wearing your India shirt. And okay, anyway, all right, we'll be quiet there. All right, good stuff. Yeah, a little personal with me. So my wife's out of town for a day. She'd run do something, no big deal. So I'm getting up. My son Sebastian wakes up. His eye is all like red and pink, and I'm like, oh my God, he has pink eye. Now I've had enough. My kids have had pink eyes. Really not the big a deal. You get the drops, they're fine by tomorrow. But I was like, you can't go to school like this. He looked terrible. Like anyway. So yeah. So dealing with that. So as soon as we're done here, I'm going to run up to Walgreens, get the medicine, and start putting that in.
Another day.
Hopefully get them. Yeah, it's always something.
I skipped town. My kids are off for 2 days for President's Day. President's Day. I don't know. Are we still calling it President's Day?
Well, I guess. I think so. So don't cancel us. We'll get canceled for something, but maybe not this. So we'll still call it President's Day for now.
So yeah, they're off for 2 days, and I'm like, they've got a 4-day weekend, and so yeah, I was with them yesterday.
I think that's true. Different states do call it different things. But anyway, well, whatever it was, hopefully everybody had a nice long weekend. We'll just leave it at that. All right, Sonu, some more stuff to talk about. We did anything else on AI or the two markets?
Well,
want to get to macro stuff?
I can keep talking about cricket.
Oh, you can talk about cricket all day long. You want to get to the macro stuff?
Yeah,
what do you think here?
I mean, we got payroll, CPI. Maybe we'll talk about payrolls first, get that out of the way, because payrolls were, I mean, this was the first clean payroll report we got, the January payroll report, because this was after that, the post-shutdown reports from November, December. It was messy. But we also got these big benchmark revisions, right? I mean, benchmark revisions. Right. The Bureau of Labor Statistics changed their methodology as to how they estimate new business formations and closures. It's called, quote unquote, the birth death model. I don't want to spend any more time talking about it. Yep. Anyway, long story short, we got massive revisions to 2025, right? And actually there were revisions all the way back to 2021. So 2021 to 2023 numbers didn't change too much.
Just in case people forgot, that's 5 years ago. So we're tinkering with data from 5 years ago. Oh boy. Anyway, all right.
But so 2024, by the way, was revised from 2 million jobs. Like 10 days ago, we thought there were 2 million jobs created in 2024. Right. That got revised down to 1.46 million. So we just lost 500,000 jobs. I have some perspective on this. I'll come to it. 2025 job growth. It was already weak. It was close to about 600,000. Really weak. That was revised down, Ryan, to 181,000. The worst year for job creation since 2003, outside of recession.
It wasn't that long ago. We were printing numbers like that every single month. It really wasn't that long ago. Yeah.
No, exactly, right? Monthly payroll growth in 2025 averages 15,000 per month.
Wow. Okay.
Right? But here's the thing, right? Like, okay, when you say, we lost close to 1 million jobs over the last 2 years, we didn't really lose it because, people who were working were really working. I mean, it's not like 1 million extra people got.
You know who lost? Pakistan. I'm teasing. I'm just kidding. We just lost any listeners. Sorry. I thought it was funny. Anyway, all right.
There you go. But we should watch a cricket match one day together. Someday.
I bet you're a wild man. I could imagine you get into it.
You get hairy. It can get tense in there.
Absolutely.
Look, just because we're just counting different. That's all. We got a better count of what happened in 2024 and 2025. It's not like 1 million extra people lost jobs, right? That's one thing to keep in mind. None of this changes how many jobs are actually created in the economy in 2024 and 2025. Like I said, it's got a better count of what happened. But here's what's amazing, Ryan. Despite such weak job growth, right? The economy didn't enter a recession. If you told me that we're going to create only 15,000 jobs per month and a couple of months will be negative job creation, I'd be like, wait a minute, the economy is probably in trouble. But we didn't see that. Real GDP growth, you'll get the Q4 number end of this week on Friday. But, it's going to clock in around 2.5%, which is pretty much a long trend, right, for 2025, I mean. So this story, we've been talking about it for a while, right? Hiring's been weak, but the unemployment rate, by the way, hasn't risen because, one thing, there are fewer workers to hire because immigration stalled. And then layoffs have been really low. Right? That wouldn't have been the case if we were in a recession and revenues and profits were falling and things like that. So the other thing is, Ryan, revisions are past data.
Well, exactly. Yeah, last I checked, the stock market did good in 2021. You might have lost a few jobs, but and even last year we gained 20%, obviously 30 most around the globe, and yet, hey, well, scoreboard still did pretty good for investors.
Yeah, the news is actually much better right now. The economy created 130,000 jobs in January.
Mm-hmm.
Expectations was 65,000. Now you can take this number, or maybe you should take this number with a grain of salt because it's going to be revised, right? For sure.
by 2032.
but okay, like take the 3-month average. Last 3 months, payroll growth has been running about 73,000.
Yeah.
And because of stalled immigration, things like that, maybe the economy just needs to create. Some people are saying as low as 20,000 jobs, 30,000 jobs a month to keep up with population growth. We're well above that if that's the case, right? So the story, I think, is, look, job creation plunged in the middle of 2025. No surprise as to why, right? We got all the tariff chaos, economic uncertainty, but it's picked up recently, right? It's still well below the monthly average in 2024, but like I said, immigration stall, right? The other thing, Ryan, the unemployment rate, by the way, has fallen to 4.3%. It was 4.6% a couple of months ago.
Yeah.
And a year ago it was 4%. So 4 to 4.3%, that's not a big increase.
Okay.
When you look at the big picture here. And the prime age employment population ratio, 25 to 54-year-olds, you and I have talked about that in the past. That's at a cycle high of 80.9%.
Right.
That matches the peak we've seen in this expansion. That is higher than at any point between May 2001 and June 2024. Which means, in layman's terms, right? More people in their prime working years are currently employed as a percent of the population than at any point between mid 2001 and mid 2024. That is incredible. And here we are, people are like, oh, is AI leading to job losses? I'm like, wait a minute, look at the employment population ratio. That's at the highest levels we've seen in 2.5 decades.
Great stuff. You mentioned the number came in 130,000 versus about 65,000. Bloomberg had a survey of 80 economists, Sonu. 78 out of the 80 expected the jobs number to come in less than 130. So that just tells you,
I think
two
Bloomberg
markets
expected like a zero number.
Well, there you go. And also, I do. You mentioned it, and let's dive in a little bit more because I know I shared on social media, and we got some interaction, so I know it strikes people. The unemployment rate on younger workers, like 16 to 19 and 19 to 24, those also sank last month by a pretty big number. And I've got it. You hopefully have it off the top of your head. But if not, we saw those numbers drop. And you said, listen, doesn't look like AI took the jobs yet. That fired some people up. I mean, I think you're kind of joking. It's just 1 month. But still, we saw improvement across the board, it looked like, especially for younger workers. You want to talk about that one?
Yeah, look, one story is, AI is taking jobs. Well, if you look at the prime age employment rate, population ratio, and Drew, we can put this chart up showing the unemployment rate going to 4.3%, employment population ratio to 80.9%, right? So that sort of, pushes back against, AI is taking over all jobs. Then you think, AI is, making it harder for younger workers.
But what if that's what AI wants us to think, Sonu?
We are all in a simulation. Maybe AI will come in and revise the data. AI is keeping the data strong somehow.
Exactly. That's what I'm getting at. That's what I'm saying. It's tricking us. Oh boy. Anyway,
but look, the other side is, but AI is impacting younger workers. Companies are not hiring. Okay, some of that may be true. Look, the unemployment rate for 16 to 19-year-olds, a year ago, it was 11.8%. Okay. By November, it rose to 16.3%. That's a big increase. Actually, since then, it's fallen. It's fallen back to about 13.5% in January, from over 16% down to 13.5%. So if that AI story was really there, it would have been like, the unemployment rate would have stayed at 16 for 16 to 19-year-olds, or it would have gone up even further. You look at 20 to 24-year-olds, somebody on X pushed back against me saying, 16 to 19-year-olds are just basic entry-level jobs, maybe people working at Baskin Robbins or wherever. That's not going to be impacted by AI. Well, 2 months ago, everyone thought it was, right? That's a separate thing.
That's true. Yeah. Right.
So now it's like, what about 20 to 24-year-olds? Okay, let's look at that. A year ago, unemployment for 20 to 24-year-olds was 8%, Ryan. It rose to 9.2% in September, right? And then that's when we're like, AI is impacting, young people coming out of college and things like that. Well, now the unemployment rate for 20 to 24-year-olds has gone back to 7.1%. It's lower than it was a year ago. right?
Okay.
The employment population ratio for 16 to 24-year-olds has also been rising since August and September. So, yeah, look, if AI was responsible for weak job growth, we wouldn't see the unemployment rate for young workers fall, right?
Oh.
So, anyway.
So what did Neil Dutta say in their podcast the other day? He's like, when Zuckerberg in the movie, what was the Facebook movie
The
called?
social network.
Social Network. He said, if you, when he's in court, talking to lawyers, and he's like, if you guys created Facebook, then you would have created Facebook. So it's kind of like if AI was truly taking these jobs away, it would show up in the data. So shout out to Neil. We have a standing rule. We have to quote Neil at least once during this podcast. So
look, last thing, right? I think the big picture is like, if you ask me, where is the labor market now relative to a year ago? I would say it's slightly weaker, mostly because we've got hirings weakened. And part of that is because we saw more economic uncertainty in the middle of 2025. No guesses why, right? But I think importantly, and this is something we've talked about since the outlook came out, the bleeding stopped. Things are looking up. And I think there's still a lot of room for improvement as we go forward.
Yeah, I mean, we're up 3 months in a row on jobs. We went 7 in a row alternating, up, down, up, down, up, down, late 60s, early 70s. Last time we saw that, I've mentioned many times, last couple of months, ADP. Now, again, we there's maybe some flaws with the ADP stuff, but nonetheless, positive jobs creation in small and medium-sized businesses last couple of months. It's the larger businesses that are more struggling. So maybe that's more canary in the coal mine positives. So I do want to play devil's advocate a little bit because I'm interested to hear your take, and this is something we hear. Private payrolls last month created 172,000, expected to be 75. So that came in way better than expected. But this is going. Healthcare and education were 137 of 137,000 of that. And I think it's right. Chart Kid Matt over Ritholtz, he said like 18 months in a row now, most of the job growth has come from every single month, education and healthcare. How worried are you that it's just coming from those two areas? I'm setting this up on a platter. I know how you're going to answer it, but what do you think about that?
I mean, my overall perspective is sort of like, over the last 3 years, the stock market's up 20-25% each year. And then people are like, oh, but if you take away the Mag 7, it's lower.
Right. Why take it away? Let's take it away this year. It's a heck of a lot better. I agree with you guys. Let's take it out. Anyway.
So that's my perspective. You can't just, it's a big sector of the economy. It's like 18% of the economy. You can't just take it out. I mean, people are getting jobs there. Yes. Would we want broader job growth? Yes, absolutely. Right. But the other side is we did see a few other cyclical areas pick up. Pace. Manufacturing, yes, it's lost jobs overall over the last year, right? That gets to that economic uncertainty piece. But it also gets to the fact that this probably was an AI, by the way, right? Manufacturing added 5,000 jobs in January. Professional and business services, these are, by the way, not just white collar jobs. They added about 34,000 jobs, right? It includes things like temporary help services. Usually temporary help services, employment starts to go up if, like when companies are starting to hire, because instead of hiring a permanent employee, they may go to a temp help agency and say, you know what, we're not sure what the demand environment is. We just want to hire someone temporarily for now. But, we'll see what happens after that. So temp help going up is a positive sign. The other thing, Ryan, construction payrolls. You're talking about home builders and things like that. Construction payrolls grew by 33,000. Now, 25,000 of that is tied to the AI story because that was mostly non-residential specialty contractors, basically folks working on data centers, right? But yeah, these are several sectors that saw job losses.
They still pay you. They still pay you. It counts.
Yeah. So you can't just throw even one sector out or anything like that. Now, this is just 1 month of data. Would I want to see broader, let's say, participation? Yes, right?
Sure.
But we would want more than just one sector accounting for 50, 70, 80% of job growth. But I think, we'll see that as we get into this year.
Yeah, no, good stuff there. That's why I figured we talk about wages up 0.4% from up 0.1% the month before, and year over year earnings up 3.7 versus expected 3.6. So numbers are solid. Unemployment rate was down. People are making a little bit more money. I mean, all in all, we probably need to move forward. But it seems like the labor market's better than it was feared a couple months ago, and we think it can continue to improve. Is that how we'll put the cherry on top here?
Yeah, look, if the labor market is cooling and we had a weak economy, I still can't believe I see people on X talking
Mhm.
about, oh, we are in the middle of a recession, we just don't know it. And like,
Right.
okay, I guess we really don't know it.
Right.
Look, we would see wage growth pulling back. We would see hours worked pulling back. None of that is happening.
Hmm.
None of that
Well,
is happening. So anyway,
well, good stuff. We'll move
yeah.
forward. I know you want to talk about inflation. I'll take a little fun detour here. The year of the horse, okay, is 19
Mm.
is now. The year of horse is not now. Now 1978 was also a year of the horse. The year your two fearless podcast hosts were born. Although, as I've said many
Our
times,
year.
Sonu is clearly older than me by a whole 5 months. It shows. It's okay. I'm not calling you old, HR. I'm not calling him old. I'm just
Hey,
saying
we're at the
he
same
looks
age
more
right
seasoned.
now, up until like
Exactly.
3 months from now.
Then you're the old man. Then you're the old man. So this is fun. Do not invest in anything I'm about to say. Year of the horse isn't that great, but so no, I was looking at the numbers. Like goat is the strongest. We can put this chart up now on YouTube.
Of course, goat would be the strongest. Right?
Yeah, the goat up almost 15%.
I
Ox
did see the
also
movie
strong.
yesterday, by the way, Goat, with my kids.
Oh, how was it?
It's fun. It's like rollerball basketball.
Did you fall asleep?
I did actually.
Yeah. Well,
Fall
so
asleep.
okay, but maybe
It was
take the chart.
afternoon,
Maybe
and we had a nice meal, and
Yeah.
like fell asleep.
Never mind. We're not going to put the chart up yet because I got a little story. We'll put the chart up in a second. So I went to see Jim Jeffries on Friday night. I love Jim Jeffries. He's a comedian from Australia.
All right.
I think he's funny. He's a funny guy. And I guess that's what it was. I was on TV super early Friday morning. I was on TV pretty darn early. Busy week, long week of travel, and then Friday morning. So I made it like the first 30 minutes, okay? And it's dark. I had a couple beers. My wife and I took an Uber, had a couple drinks. We got our bonus on Friday. Felt like, whatever. Had a nice meal. Felt pretty good about things. Had a couple beers. Dude, 30 minutes in. Jim Jeffries is hilarious. He was awesome.
Mhm.
I'm like, my wife's like, you're snoring. I go, I'm what? I shook. I'm like, what? So I tried so hard to stay awake, and I'm laughing. The next thing I know, I'd fall asleep, and I was in the back.
Did he call you out? Did he?
I would
see
say
you?
no. Luckily, it's a big place.
Like,
He would have. That'd been something to get called by Jim Jeffries. I think he's great. Anyway, so it got to the point where the kids were, 3 kids in 3 places, and we're downtown to take an Uber home, Cincinnati. So we left a tad early. She's like, we just have to go because I just kept bobbing my head. I was so tired. Anyway, so Jim Jeffries, I'm a fan. He was funny. Jim, I'm sorry for falling asleep. It was a long week.
CNBC for inviting you at 5 a.m.
I had an early hit. Anyway, all right. Now, with that out of the way, the year of the horse. I noticed the goat. We can put this chart up now on the YouTube channel. Goat is the strongest. Ox is second strongest. Dog and pig, and then rabbit. I'm thinking, all those, they all have 4 legs. Well, what really got me was the snake and rooster, Sonu, are the 2 worst. They don't have 4 legs. So I really looked into it, and these are called a quadruped. If you use like all 4 of your legs, you're called a quadruped. So anyway, when I looked into this, again, please, everyone, never invest in this, but the market's up 11% when you have an animal that walks on all 4 legs, median of 12% versus a median of 9, an average of 6 if they use no legs or walk on 2 legs. So there you go. One reason to be bullish is the horse does use 4. Now, here's where something came in. YouTube, let us know your take. I said dragons didn't walk on all 4 legs. I'm used to the what Lord of the Rings, or not Lord of, what's that show?
Smaug.
Yeah, anyway,
some of them.
Yeah. So those didn't, but apparently the Chinese dragon does walk on all 4. So dragon's kind of right in the middle-ish in terms of returns.
Okay.
So I don't know. I said no just because that's what it's not Lord of the Rings. What's that show on HBO called?
Game of Thrones.
That's it. Thank you.
Yeah,
so Game of Thrones, I was thinking the Game of Thrones dragons. Those dudes, they don't walk on 4. They walk on 2 or they fly.
On 2, yeah.
Anyway, but apparently
like they use their wings too to walk.
Yeah, they fly around and blow everybody up with fire and all that stuff. So again, tale of 2 markets. There's 2 types of dragons. I can't believe we're wasting our time on this, but it's usually pretty fun. So in the YouTube comments, let us know next time we do this, should dragons count as 2 or 4? I don't know. Anyway, so that's a fun one. I did a blog that was pretty well received on spurious correlations, carsongroup.com/research. It, the Super Bowl indicator, Friday the 13th, no, you should never invest in these. But I would argue, is it just as spurious when you look at it, one chart of the size of the balance sheet overlaid with S&P 500 and what's happened in the last 4 years?
Thinking about that.
Yeah, or saying the yield curve every time it inverted 8 for 8, we had a recession. Maybe it's not so simple. I mean, listen, these are fun things, but a lot of the stuff that we all use to a degree, at least a lot of people did 3 years ago, we were promised a recession. ISM manufacturing sub 45, LEI negative year over year, the SOM rule had triggered. Some of those might have been more spurious than people wanted to admit looking back. You want to dive into that, Sonu? Because I think it's kind of a fun conversation.
Yeah, look, the whole balance sheet and the labor market, we should have Claudia Sam back on. I mean, it's been a
Hmm.
while, maybe
Yeah,
for one of our social hours or something.
yeah,
But yeah, no, the whole balance sheet thing is, I think it's much ado about something of nothing, about nothing, I should
right.
say. I mean, the balance sheet is big. I don't mean to say that it is nothing, it is massive. But if you muck around with the balance sheet, money markets are going to hit the skids, and nobody wants that. Least of all, I don't think President Trump wants that, right? Because
Yep.
that's going to create consternation in the stock market, like it did. Remember back in 2019, it was fall of 2019, September, October, somewhere we had that repo get in. The repo markets went
Hmm.
nuts. So yeah, I think the Financial Times had a piece on how Wash is going to come in and he wants to shrink the balance sheet. He's going to work with Besant at Treasury, and yeah, I think it's. I don't think any of that is going to happen. And then kind of like Claudia Sam has been a trooper on the net talking about, you know, helping people, I think, understand and putting down all those conspiracy theories around why the BLS does or measures things the way they do, because it's easy to knock the BLS and like, look at all these revisions, right? I mean, we've suddenly lost 1 million jobs over the last
Right.
couple of years, right? This is ridiculous. But look, response rates have been lower, right? These are surveys, but these are massive surveys. And that's taken, a hit to how they count jobs. And because of
Hmm.
that, the revisions have been larger than normal.
Yep.
And they've lost a lot of funding too, by the way, right? The BLS, the BEA. And this is where, it hits folks like us who want a better macroeconomic picture. We don't
Hmm.
get that anymore because funding has gone down,
Yeah.
right? So all of this is intertwined. And yeah, we should maybe talk to Claudia about it sometime.
Yeah, I saw a guy Berger just has a new. I think he has a new job. I think I saw something on
Yeah, I think
LinkedIn. So
so.
guys, so guys,
Congratulations to the
guys,
guy.
another acting great. We've had Guy on before. Guy's awesome. So anyway, February 28th is what they're calling the Planetary Parade. If you haven't heard this yet, Sonu, but it's one of the few times
Yeah.
in the history, at least our lifetime,
Oh, I
where
think I saw this. Yes.
yeah, six planets are all going to be visible for about 30 minutes to an hour, depending where you live. The planets are Mercury, Venus, Jupiter, Saturn, Uranus, and Neptune. And it's called the Planetary Parade. So, you talk about like Year of the Horse and zodiac
Mhm.
signs. Now, this is a legit one. So, February 28th, check it out. Hopefully, it's what's the word I'm looking for? A clear skies wherever you live. You can see up to six planets, all just boom, 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 all next to each other, which should be pretty cool. And I did see a
When
crazy
was the
movie.
last time that
Oh,
happened?
I don't know. I'm not sure what to look at. I don't know. It's pretty darn rare though. But the movie Begonia, I don't know if you even heard this one. It's like a wild movie. Is like a Paramount, I think, is about like end of the world and aliens and all types of stuff. So I was thinking that's all these are always around like comets and stuff. These scary, these
Hmm.
not scary, but these alien movies. And I'm thinking, oh
Sure.
boy, February 28th, we've got something happening in the sky. So if anyone's going to come visit, I don't know, maybe another reason to get the banana peel in February out. We'll see. All right, so we've gone plenty long. I know you want to talk about CPI. Let's wrap things up with the inflation backdrop. Want to do that?
Yeah, yeah. So the one thing with so this is January CPI data, and over the last 3 years, for those of you paying attention to CPI data, which I recognize most of you probably don't,
Mm-hmm.
January CPI tends to come in hot.
Okay.
It surprises to the upside. It's been doing that for several years. That's because companies charge higher prices, they change their pricing strategies, things like that.
Right.
That usually happens at the beginning of the year. So every year is, I think, bracing for an upside surprise. And of course, if everyone's bracing for an upside surprise, that means expectations are going up.
Mm-hmm.
And guess what happened? CPI came in right along expectations, right? Headline
Right.
CPI came in at 0.17% month over month in January. You translate that to an annualized pace, that's 2.1%. Right? Not bad at all. It's right along expectations. It's thanks to look, gasoline prices went down about 3% in January. Grocery prices elevated, but not as much as previous months. And then you look at core CPI, Ryan, it was actually up 0.3% month over month, also along expectations. People are like, oh, it was like a sigh of relief, right? It could have been zero point 0.4, but it came in at 0.3, was as expected, no upside surprise. But 0.3%, Ryan, still
Mm-hmm.
translates to 3.6% annualized,
Hmm.
right? Just to keep that in
Okay.
perspective. Now, the last 12 months, core CPI is up 2.5%. A year ago, it was up 3.3%. So you look at the big picture, like, wait a minute, core CPI is done come down a lot. And part of that is because of shelter disinflation. Remember, shelter
Right.
makes up about 42% of the core CPI basket. So it matters, a lot for CPI. It matters less for PCE, which is the Fed's preferred index, the personal consumption
Hmm.
expenditures inflation metric. In there, shelter accounts for about 17% or so. But anyway, coming to CPI, shelter's pulled back a lot. It's normalized. It's probably even slightly below where we were before the pandemic in terms of shelter inflation. But part of that is because of a lot of data decisions. Let's call it that, data decisions. The BLS made in October. Remember, October was a shutdown.
Yep.
So there was no data collection. So what did the BLS do? They assumed zero price increases for a whole bunch of goods, including shelter. Now, shelter, you can argue, look, disinflation is already coming. You and I have been talking about that for about 3 years now, right?
Like
Like the private
we
markets data is,
so let me jump in. We manage real money. Like the next time we have a bad month, can we just say, it was about zero? I mean, because it's probably negative. I'm getting like relative to your benchmark, you're probably down. So we'll just use zero next time we have a bad month. I'm sure that'll go over well. Yeah.
so that's the thing. Look, in the case of shelter, like, okay, fine, you assume zero, but there was a big lag that official shelter data, inflation data had to the private market data.
Hmm.
So that disinflation was already coming, and now it's accelerated because you assume zero. Thing is, they assume zero for a whole bunch of other stuff too,
Right.
right? And so that basically pulls the year over year number down lower, and which is why core CPI is up 2.5%. I would say it's probably close to 2.8, 2.9%. Remember,
Mm.
it's 2.8, 2.9%, even after getting a whole bunch of shelter disinflation. Shelter is normalized and you're
Right.
still elevated, right? Which is why I think, look, I don't want to come off as, or sort of become an inflationista or anything like that. No, I'm not, right? But I do think the Fed has a little bit of a problem here,
Hmm.
right?
Okay.
If you look at, okay, set aside shelter, let's look at the other two pieces of core, CPI, which is core goods. And then
Hmm.
you have core services shelter, excluding shelter. You look at commodities excluding food and energy. This is core goods, right? That was flat for the second month in a row. It was
Right.
flat in December, it was flat in January. But this is because of a 1.8% drop in used car prices.
Right. Huge drop.
Yeah,
Yeah.
there's a big drop. And now actual private market auction price is actually showing a pickup. So that will probably feed into official data over the next couple of months, but set that aside, right? That actually hid a lot of price increases across other goods. You look at household furnishings and supplies, right? That was up 0.3% month over month in January. It's up about 4% year over year. Apparel was also up 0.3%,
Hmm.
right? When you hear 0.3%, think of that as somewhere between 3 to 4% annualized pace.
Okay.
Video games, audio products, things like that. That was up, Ryan, 2.2% month over month. Just over 1 month, 2% increase. That's a big deal, right? That's
Yeah.
over 20% annualized. Pets, I know you have pets. Pets and pet products up
Hmm.
0.3% month over month. Sporting goods, 0.6% month over month. They're talking now something like, 7% annualized pace for some of the stuff. Computers and peripherals, and this gets to the whole South Korea DRAMs, things like that. Computers, peripherals, other electronic goods like that, that was up 3% month over month. That's a big increase, right? All of this stuff was hidden by the fact that used car prices went down. But underneath the hood, and you don't have to look too far underneath the hood. You're like,
Nice
wait a
play.
minute.
Nice play on words, but used cars under the hood. Yep.
Prices for all these goods would be falling. We'd be
Okay.
seeing deflation. That's what we saw for 25 years, right? From the mid 90s all the
It's
way to
true.
2020, 2021, right? But now they're actually going up, and they've picked up pace a little bit in January. I know it's just 1 month. We'll see
Yeah.
where it comes. I think we'll talk about the whole, memory chips and things like that. I think there's probably going to be more inflation coming that way.
Okay.
But there's heat even in the service sector, Ryan. Like, if you look at core services, excluding shelter, that was up 0.6% month over month.
Mm.
0.6%. That's like a 7.3% annualized pace. Over the
Okay.
last 3 months, it was up 3.7%, right? Over the last year, it's up 2.6% year over year. But remember, that's because a lot of prices in October was assumed to be zero, right?
Yeah.
Or I mean,
True.
0%
True.
inflation, that is, right? But you look at, like Video and audio services. This is like cable streaming and things like that. That's up 4% year over
Oh
year.
my goodness! Every time I turn around,
Yeah,
yeah,
and they're
I
increasing
pay for all
prices.
my stuff. Yeah,
Pet
way
services,
more than inflation. I'll tell you that.
like pet services. I know you've taken your dog to the vet as well. That's up
Hmm.
6% year over year. Admissions, movie theaters, concerts. You're just watching Jim Jeffries.
Yeah.
Prices for that
Well,
stuff is going
so no,
up.
I only watched like 30% of it because I was asleep. I know airline tickets are up over 6% also. They had a big
Yes.
jump in
Yeah,
airlines.
yeah, exactly.
Yeah.
Admissions, prices, movie theaters, concerts, that stuff's up 4% year over year. Personal care services, this is like, haircuts and things like that. That's up 5% year over year. Laundry and dry cleaning's up 6% year over year. You get the picture.
Wow.
I mean, all of this stuff is,
Yeah.
it's elevated, right? Like I said, I don't think inflation's going to be 4% or 5%, anything like that. But I don't think it's getting closer to 2%. I think we are kind of stuck near 3%. I think that's a
Okay.
problem for the Fed.
No, that is. I know food was up 0.2%, which was a little bit of an ease from the month before, and medical care also was up 0.3, a little bit of improvement. But the reality was, what did the 10-year yield do last Friday? It was down 5 bips. The 2 days, Thursday and Friday last week, the 10-year yield was down, I think, 12 bips, which is one of the largest
Yeah.
2-day drops ever. I'm not sure what it's doing on whatever day today is, Tuesday. We're doing this, so the market. And listen, there's a lot of different factors to why yields drop, but they did drop around this. I think I saw about 50% chance, coin flip of a Fed cut by June. Is that the
By June,
latest? By June?
it's
So,
about
yeah,
less than 30% for March and April together, which means,
right, right,
the market's not expecting the Powell Fed to cut rates anymore. But the
right.
moment Walsh takes over, suddenly the odds jump to 87,
Yeah.
88%. Right.
I mean, we've talked enough about it. I think he's got a little handshake, wink, wink. I'm going to give you some cuts.
Yeah, yeah,
I think
yeah.
he kind of has to. But
So,
I'm with you. So a lot of this, I mean, it's we just look at the prices of commodities. It is what it is.
yeah.
They're obviously soaring.
And
For
going
the
back,
most
like
part.
energy is like the top performing. It's up about 21% year to date.
Mhm.
Materials are up a lot too. I know
Materials are right
staples
there.
are there. It's
Mhm.
like you said, the stuff you can,
Mhm.
drop and it'll hurt your feet.
Mhm.
Right.
Yeah.
The other thing, so all the CPI, okay, granted, it's backward looking. It's January data. We're yet to get PCE, by the way. We're yet to get even PCE inflation data for December, let alone January. That's expected to come in pretty hot
Okay.
because, that has a lower weight to shelter. And all this other stuff that I mentioned gets a larger weight in the PCE inflation data. Right. But looking ahead, one thing, coming to portfolios, right? Our strategic portfolios, our secular longer term outlook, 3 to 5 years, are, we've been writing about the fact that we think inflation is going to be volatile over the next several years. It'll still maybe average between 2.5%, 3%, something like that. Doesn't seem
Okay.
a lot above target. Maybe the Fed lives with it, but we'll see periodic surges, right? And that's why we overweight diversifiers like managed futures, which brings in commodity exposure, gold as well, right? And especially if you think the Fed's going to keep rates lower, even in the face of elevated inflation, right? Now, when you talk inflation surges, what comes to mind? Like, oh, let's look at energy prices. Are they going up? Yes, it's been going up, but it's nothing terribly scary like what happened after Russia's invasion of Ukraine, right? In 2022. But we are running, Ryan, into a memory chip shortage. Does that sound familiar? Right?
Yes, it does.
Bloomberg had an interesting piece over the week, I think it was over the weekend, showing how there's a shortage in memory chips, and that's starting to inflate price tags. Price tags for laptops are expected to go up, smartphones, gaming consoles, cars, and data centers too. Data centers, everyone's spending money like no tomorrow. So maybe we won't even notice that prices are going up for this stuff. But look, even Apple and Tesla are coming out and saying, look, there's a shortage of something called DRAMs. This is dynamic random access memory. And that's going to curb production or reduce margins for these companies, right? And basically, the squeeze is being driven by the build out of AI data centers, right? What Bloomberg said that, look, a lot of AI chips in these AI accelerator type chips that come with a big requirement for memory. You need memory to run chatbots and applications like that. And you don't have a lot of memory for that because this is all going towards the AI data center stuff, right? So the cost of one particular type of DRAM surged about 75% in January. Another, overall DRAM spot price over the last several months, it's up about 600%, right? Every NVIDIA chip, Ryan, that you read about that's NVIDIA's releasing requires more and more memory, right? Some of these chips are as powerful as a whole bunch of powerful PCs put together. right? So costs are going up, demand is surging because the AI demand, we've talked about that, data center construction, is going through the roof here, and companies are just trying to fall over each other, saying we're going to spend even more to that, right? But look, companies can probably take a hit to their margins if costs surge. My guess is that's not going to happen. That's going to pass to end consumers, right? But we may see actual shortages as well. Remember, the chip shortage in 2021, 2022 is what sent the cost of cars, used and new cars.
Oh, yeah.
Right? Computers, electronics, all of this stuff. So this is probably going to come down the pipeline in Q2 and Q3. And I think this continues. Now, the other side of it is like, who's benefiting? That gets to South Korea markets. The South Korean market is up 35% year to date. What are the big companies in South Korea's index? Samsung, SK Hynix, memory, right? Those firms, and then you add Micron as well. So these three companies, the total market cap, Drew, we can put this chart up showing the market cap of Samsung, SK Hynix, and Micron. The total market cap 6 months ago was about 400 to 500 billion. Right now, it's 1.8 trillion dollars in market cap. 1.8 trillion in market cap.
Wow.
And this gets to that whole, you and I, we've talked about that super cycle of commodities. This is a super cycle of AI demand, super cycle of memory chips, right? And that, I think, is going to potentially increase the price of goods across the board.
No, I can't disagree. There's a lot to unpack there. We've probably gone long enough.
There's a lot there.
I guess let's keep it simple. It's why we say be overweight equity still, but be diversified. I mean, stay diversified. You kind of mentioned, if the drop it hits your foot. Well, yes, we have constructed our portfolios to be a little bit in that world, a little bit underweight bonds because commodities do better. Interest rates stay maybe a tad higher than the market thinks. Bonds might not do as well. We absolutely have some bonds in our portfolios. We've seen bonds did pretty well at the end last week. Utilities have started to take the baton back a little bit. Now, utilities, listen, is it a Echo AI trade? Maybe it's positive. I've said maybe the strength in utilities all of a sudden is a sign the tech trade might be coming back sooner than later also because AI is a big part of utilities as well. But anyway, you watch anything in particular this week besides working on your tan out there in California?
I know. I'm Palm Springs, and then I drive out to Utah. So I'm watching the road. That's what I'm watching.
There you go.
I don't think I have time to watch anything else.
Well, you're going to Yuma, right? Don't you go to Yuma,
I'm
Arizona?
going to Yuma as well. Never been there. That's right at the border too, I think, right? So
yeah. Oh, I mean, Yuma is next to Mexico. I've gone to Yuma the last couple of years, and I think I always remember everybody flies to Yuma on the plane talking about getting their teeth done because everybody goes right across the border in Mexico. And I've never done it. I just hear people on the plane talking about it. You go to Yuma, right across the border, you can get your teeth done really cheaply, like lasered and nice and whitened and everything.
Really?
All these dentists.
You should have told me that before. I would have spent an extra day, and my wife probably wouldn't have blamed me for that.
Well,
like, honey, I'm just going to get my teeth done.
Get your teeth all cleaned up. But I mean, just go right across the border. Not saying you should do it. I'm just saying that Yuma is, and Yuma is also the sunniest city, like in the I think in the world. I think like 361 days a year. It's not like Death Valley is like the hottest area in the United States, and almost one of the hottest in the world, actually. And Yuma's right around there. But in terms of sun, I think it's 362 days a year you have sun in Yuma. So hopefully you get plenty of sun when you go visit Yuma as well. All right, everyone. Well, this was a lot of fun. Sonu, lots of good stuff there. Lots of stuff to keep thinking about. We're going to keep doing it every single week. Episode 175 of Facts versus Feelings, a tale of two markets. Also, we're doing another, what's the date, Sonu? The 28th?
Social
28th,
hour.
Social hour on the 27th. On the 27th, we're doing another social hour. We'll be promoting that. And who do we have again?
We have Cullen Roach from Pragmatic Capitalism. He has got his own ETFs too. Cullen's great. He's a great macro guy as well, right? And he understands a lot of plumbing as well. Like, you're talking about the Fed's balance sheet and things like that. The first time I came across Cullen, this was about over a decade ago, was when he was fighting it out on Twitter at the time with all the MMT people, right? So it'll be fun.
No, yeah, Colin's great. I've heard some recent podcasts. He has a book out, so he's doing the podcast circuit, but we reached out to him. He'll be really good. So definitely check that out. I don't think we have the links to them yet. We've asked for it, so hopefully we get the links soon. We'll start sharing that. You can sign up for those on 2 Friday.
That's next week, not this coming Friday, 27th.
2 Fridays. Yeah, we're hoping to do the last Friday of every single month this year, and that'll be coming up. But just keep it on your radar. All right, Sonu, we'll enjoy California. Enjoy all that. Tell the Yuma guys I said hi, and yeah, I'm sure you and I will talk soon. I'm gonna go to Walgreens, get my son's pink eye medicine.
All right,
and,
good luck.
Do a few more things. So, all right, take care, everybody. We'll see you next week. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.